Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm licensed for life insurance and annuities in nearly every state in this country. So if you're in the market, I specialize in high cash value designs at the lowest possible expenses. I would love to help you out or give you a second opinion, give you some illustrations. You can meet with me for any of these things at my Calendly link, which is right over here. Just choose one of my free options and let's have a conversation, see if I can help you out. Today, we're going to be exploring the index options available with the Securian IUL. This is a fairly popular product. There are a couple of different competing products inside of it. We're going to look at the differences in index options. That's essentially the difference between the two products. One of them is the Balanced Growth Accumulator 3, and the other one, the Eclipse Accumulator 2. Now, there are a few iterations of these products. Recently, there was the Eclipse Accumulator, and they just came out with the Accumulator 2 replacing the Accumulator. And so we have a couple of different rates listed depending on when you had the old product. There's only one for the new product because this is new. And then we have the Balanced Growth Accumulator, but prior to that was the Balanced Growth Accumulator 2. And so we're going to see some slightly different rates depending on the dates you started that policy. These are the fixed rates currently for these products. So as of September 2025, the Eclipse Accumulator 2 and the Balanced Growth Accumulator 3 are at 4.25%. If you're in one of the old iterations, you're going to be at 3.5%. That's simply a reflection of when these products were developed and sold, and that was in a lower interest rate environment. So we'll tend to see much better numbers on everything that was done after September 15th, 2023. Even in the older products, if you started your policy after that, you get slightly better rates, as you can see here, 4.25%. That was the fixed accounts. Here's our index options. In the Eclipse Accumulator, this is the old iteration, but it's still available in California and Oregon because we haven't had the new one approved yet in these two states. So current cap rate on the S&P 500, 10.5%. This is your normal S&P cap that's available with any IUL out there. Remember, we look at these to give us a window into how much money is going into the options budgets for these products. 10.5% is a respectable number. It's not the best one out there, but it's not the worst either. The real attraction in these products is the uncapped index options. This one has access to the Eurostoxx 50 at 100% participation. This one also has a cap, 14%. But then we get into our uncapped options. We get an S&P 500 low vol. So this is a volatility index. You get a 65% participation on the S&P 500. That one ends up uncapped. The S&P Prism. This is one of the elite index options out there. It's also a volatility index, but it has performed very well even in the high interest rate environment that we're in right now. Not very many volatility indexes can say that. These older products come with a 215% participation rate. And then we have a rainbow account at a 10.5% cap. And then we've got the index loan account with this product. If you're taking out a loan and you're using a particular loan type, it's going to be allocated to the S&P 500 with an 8% cap. All right, not very many people have this product. If you're just getting into this and you opt for the Eclipse Accumulator, this is what you have access to. We have a 10.5 cap on the S&P 500. That low vol also 65%. No change there. No change on the S&P Prism participation rate, but they added a trigger account. This is a great hedge option. Also available in one of our other really popular IULs, the trigger rate 8.25%. If you opt into an S&P 500 with a trigger rate, there's only two results that come about if you're in this option. They're going to measure where the S&P is at your anniversary date, and a year later, they're going to measure it again. And if it's negative, you get a 0. If it's flat, exactly flat, or positive at all, you get the trigger rate of 8.25. S&P tends to be positive 3 out of 4 years, so you could get 8.25. 3 out of those 4 years, 0 on the other one. That's an average of a little more than 6% over those 4 years. That's a pretty good deal. It says uncapped, but I don't know why. It's actually just one solid rate. You will not get more than whatever the trigger rate is on this one. Then we have this new one. It's the hindsight account. This one has a cap of 9.5%. This one's going to be a little hard for you to read, but the hindsight index account is made up of the S&P 500, the NASDAQ 100, and the Russell 2000. The segment growth rate for a hindsight account is weighted based on the relative performance of each reference index on the index credit date. 60% of your credit will come from the highest performing index, 40% from the second highest, and nothing from the lowest. So they're going to take, of these three, the lowest one out of here. So that can be kind of a neat option because S&P 500, exposure to the top 500 stocks in the US by market cap. NASDAQ 100, heavily tech-focused, although overly represented in the S&P 500, but sometimes the NASDAQ 100 does quite a bit better. And then your Russell 2000 is your small cap. So you do get some different exposure here. That one could be a good hedge option as well. Let's move on to the Balanced Growth Accumulator. This is the flagship product here. And really, it's the index options that are available in this. Underlying costs, the way that it works, almost everything is the same as the Eclipse, but we get different index options, a lot more uncapped options, and better participation rates. Now the S&P, it's the same budget going towards it. So we got 10.5 cap for S&P 500 point to point. This is a very attractive option here that gives you potentially way better access to the growth in the S&P 500. It's a 2-year term, 100% S&P allocation, but 110% participation rate. It is uncapped, but there is a spread each year of 2.5%. So what that means, if the S&P goes up 7.5% the first year and 20% the second year, you're going to get a credit of 5% the first year, because 7.5 minus the spread, 2.5. And then in the second year, 20% minus the 2.5%. So we got another 17.5 for a total of 25% credit over those 2 years. And then multiply that times 110% participation rate. Wow. That one can have some really good returns depending on when you get into this product. Now, right now, they have this other calculator that's may end up factoring into this at some point. But the way that the calculations work, you get this declared rate times the allocation rate, and it could get added into this. But 0 times 2% is 0. So it doesn't mean anything at this point. It can't get worse than where it's at, though. Your credit is essentially 0 based on the way these numbers work for this. So we just ignore this for the time being. And it lists this on each of these, but we just ignore this. Okay? That's basically all you need to know about this one. If they ever put in a higher declared rate, you're going to get better numbers. But I haven't seen them do that yet. All right, next index option, we've got the Balanced Index Account, S&P Prism. This is a 1 year. You get the 215% participation rate, same thing that's available in the Eclipse product. No spread, 100% participation. Oh, I think I misspoke there. It's 215% index allocation, which is the equivalent of a 215% participation rate. So if the Prism Index, which is a volatility index, if this returns 10%, you're going to get 10% times 2.15. So you'd get 21.5% credit. Good opportunity for growth there. But even better than that is the 3-year segment. This one balances out a lot of the ups and downs. And there's a really good chance of a credit over a 3-year period. You get a 340% S&P index allocation at 115% participation rate. So not only do we get the bigger number here, but we also get the bigger multiplier here. There have been some pretty good growth in this. And we're going to pull this index account up and look at the performance over the recent years. But let's use an example. Let's say over the 3 years, you get a 10% return. 10% times 340 or 3.4 means we've got a 34% credit. And then we're going to multiply that times 1.15 for an actual credit of 39.1%. That's a pretty good deal. Now, there isn't going to be too often where you might get a 10% return in 1 year and that same 10% over 3 years. In fact, it's been quite a bit higher than 10% in a lot of the segments over 3 years. But even in the ones where it's not, you still end up with a pretty good average return over those 3 years. So this is a really popular index option. The next one is the SG. We're going to call it the SGAI. This one is uncapped, 105% participation rate, 205% index allocation. These are multipliers. This is what this one means. It uses a rules-based AI model in order to do its forecasting. Because of the participation rates and the multipliers, you actually get a pretty decent return. Now, the performance, let's hop into the performance of these things. In the back-tested model, in the low interest rate environment, it did very well. But its inception date was right when the high interest rate environment started, and it went down, but then it climbed back up. And right now, it's essentially slightly positive compared to where it was back in 2022 when this thing first started. Now, the S&P is obviously caught up. The S&P has just been a monster. We're not going to have much comparison there. The key to this one is that participation rate. Over the last 3 years that this has been active, it's grown 4.17%. Okay, at 4.17%, if you have a 200% participation rate, 205% participation rate, or 105% participation rate, 205% index allocation, you've got a multiplier and a multiplier. You did not hold this over those 3 years, but you have an annual point-to-point. So your first year would have been 0, no credit. But then after that, people have been getting some pretty good credits in here because it did go up quite a bit. Now, the whole market went down here, and who knows where some of these index options will be. But there have been some really good credits with this index option that I've seen. So it can be a good annual point-to-point option if you don't want to have everything in a 3-year term. I actually like to take a look at using some in this 2-year, some in the 3-year, and we start out with some in a single year. And I like this one for the single year. Now, the other option, you have the index loan account. So if you do take out a loan, you can either have it be a loan that gets allocated to a separate index loan account, or it stays allocated to whatever your index options were, or you can do a fixed loan. So you have multiple options. But if you opt for their loan account, this is the allocation for that. It's uncapped. You get 150% in the S&P with 105% participation rate. 150% in the S&P Prism. This doesn't spell it out, but it's right here. So you get 150% in the S&P Prism, 105% participation rate. So not quite as good as what you can get up here, but your loan rate ends up being fixed. So it's not a terrible option. I generally prefer to pick my own index options for these types of things. But in the first year of owning this product, you don't have access to the index options. You can only take a fixed loan for that first year. After the first year, the participating index options open up to you. Let's take a look at the actual S&P Prism. This is the golden child of the index options available with this one. Now, over the last 5 years, this is an annualized return of 3.33%. Now, in the current product, with that BGA 3, you're getting a 340% participation rate. I keep calling it the participation rate. It's a 340% index allocation, which is just like a participation rate. It's another multiplier, but then you're also getting that 115% participation rate. So we're going to multiply that times 3.4, times it again by 1.15. And like if you got that every year, you're over 10% on that. Reality is it's not going to quite be that way, but this has gotten some good growth. Now, here in 2022, where we hit the high interest rate environment, this is one of those few index options where it didn't just drop and trade sideways down here. It did drop a little bit, but it's mostly traded sideways, and it's gone up. So we've had very similar performance to this that we see with like the PIMCO index over with the Allianz product. Really, really happy with what we've seen for actual crediting from this index option, even though it is a volatility index. So that's the S&P Prism. That's what it looks like over the last 5 years. You can come play around with this stuff. Like I said, the index options that I like to use in this product, we like the 3-year, we like the 2-year S&P, and I like Société Générale, is the SocGen. So, but this is an AI one. And so I like that one for at least the first year. This product gives you the option to do a dollar cost average. So you could end up with 12 different annual point-to-points. There's an attraction to that when you're using these 3-year and 2-year index options. There's no lock feature with these. So whatever you put in with this 3-year one, you're not going to get a credit for 3 years. After that point, though, if we're using the dollar cost average, we could potentially get a credit every single month after that, based on when the 3-year one ends each month. Same thing with the 2-year segment. So you could potentially get some credits every single month once you get past that initial phase. This is why I like to use the 1 year to start with some of our allocation, because I like to see some credits come in during that first year. I don't like to wait 2 years or 3 years. And a lot of people don't like to either. Like, you kind of get antsy. Like, I've got this money tied up. When am I going to start getting credit on it? So part of it is psychological. But after the first year, we start allocating to the 2-year and 3-year segment with what we've had in that one. That's essentially the plan that I would have if I were in this product. I don't own this product currently. I own a whole bunch of other IULs, and those were almost all purchased before this one even came out with these much higher participation rates. This one did get quite a bit more attractive after September 15th of 2023 when the rates all went up. But my first purchase was my top seller in the Allianz, and that's what I ended up getting a bunch of. So will I get one of these in the near future? Probably not, because I have a lot of mech space in my Allianz. But if I was looking to diversify my holdings, would I consider this product? Absolutely. I don't have any issues selling this product or owning this product if I didn't already have so much of something else. So hopefully this gave you some good insight into Securian index options and what's available. As you can see, these uncapped index options in the BGA 3 really make this product look a lot more attractive to me than the Eclipse. Having access to that 2- and 3-year option, being uncapped, can be big. And all in all, it's just a more attractive product. Not every agent can offer the BGA product though. So if you're talking to an agent and they're pointing you to this one, see if they have access to this one. It's definitely a better choice, in my opinion, the balanced growth accumulator. But you have to be with a Nexus. And Nexus is a separate company from Securian who designed these products for Securian. They've also designed products for other carriers, and we may end up discussing those here. But of those products, the Securian one does happen to be the best from what I've seen. That's all I've got for you today. Take care. We'll talk to you again soon. And if you have any questions or comments, put them in the comment section below. Happy to help you out. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.